Uh, Good morning, everybody. I'm here to introduce Mr. Ravi Jagannathan, member of the Institute. Ravi Jagannathan is the founder and CEO of Prerequisite Technology, a company which is be there in US, Netherlands, India, as well as Middle East, I believe. Ravi Jagannath is a tech-savvy dynamic thinker with over 30 years of global experience and building deep tech ventures driven by passion and supported by a brilliant team of professionals. Ravi, with strong understanding of KPI concepts, have established eMudra, a highly secured trust center for issuing digital signature certificates to Indian public in 2008, and Cripsy Technologies, a global blockchain tech and research company in 2005. Cripsy currently present in India, Netherlands, Dubai, and USA. Contributing to many, Ravi Jagannathan is contributing to many lectures and seminars relating to blockchain to promote adoption of blockchain across the globe. Ravi is a renowned person in blockchain world. Ravi is also a member of a blockchain expert team that advises UN CE Fact, a matter relating to blockchain use in trade facilitation processes. Ravi co-authored various innovative methods. Patents are still pending for it, relating to cryptography, consensus, and blockchain concepts. A fellow member of the Institute of Chartered Accountants of India, he has provided management and joint venture consulting services to global clients during initial years of his career, and later on diversified his interest and focused on information technology industry. A part of senior management team in UBICS Inc., ICI Infotech Inc., and 3i Infotech Limited. He has spearheading multiple functions in the US, UK, and India operations. He is regularly called upon to participate in many India and international panel discussions and seminars. His latest research topic is established in blockchain protocol exclusively for diverse economy. Now herein I present Mr. Ravi Jagannathan. Thank you.
Am I audible? Hello? Am I audible?
Sir, are you able to
Am I
hear us?
audible? Yeah.
Hello?
Yeah. Hello, am I audible? Okay, can I start?
Hello?
Yeah, can I go ahead?
Yeah, yes.
My screen is visible to everyone, right?
Yes, sir.
Okay, hey, good morning, everyone. And it's a pleasure to be here among the power of accounting professionals in India. So I'm calling you from Dubai now. It's a sunny day here, and I hope Bangalore is also kind of the sun effect is settling down. So today's topic I'm going to cover is about introduction of virtual digital assets and a blockchain technology that is powering the digital assets. That's what today's topic given to me. In the next an hour plus, I'm going to talk about both these concepts, and probably leave it some time for the audience to ask me questions if there are any specific questions. Before I start the session, I want to introduce myself. Thanks to the member who introduced me. I'm a chartered accountant. I started my practice in way back in late 80s. I was practicing until 98. Then I decided to move to technology world, and then I went to US, and then I was working globally. And then again, when I came back in 2008, I started eMudra. That was my first startup. And after that, I did few startups, including TaxSmile, which is an online tax ERI, right? So that's what I did. And then after some years in 2015, I started Cripsy. Cripsy, we started with a very clear objective of making a digital world trustworthy so that people can rely on digital world, because as Mr. Prasad was saying, there are so many issues that we can see if we don't have the right kind of authentic information available to all of us. It might hit our healthcare, it might hit our anything, right? Because everything is virtual and digital. That's what we are seeing nowadays. So that's what I did in 2015. That is Cripsy. So Cripsy is a purely blockchain technology company. We don't do anything in crypto currency world, or we are not traders or exchange or doing anything in cryptocurrency. I don't do anything in cryptocurrency as well. So with that, I would like to start. Today's section given to me is about understanding of virtual digital assets and blockchain technology. I'm not getting into the shoes of or the topic relating to the taxation, whether it is the right thing to do or wrong thing to do. I think there are other members who would like to probably talk about it in the later sessions. So quickly, okay, before I get into digital, I'm just flipping. I'm first talking about the technology and then go and talk about the assets, because the understanding of the technology is very essential before we talk about the asset, because the asset is being defined in our Finance Act and there are so many other bodies. But understanding of blockchain in a non-technical way, that's very, very important. Wherever I go and talk to senior management or professionals, first what I would like to do is make them understand what blockchain technology is about. What blockchain technology in a non-technology way, understanding that is very essential for business people to understand the power of blockchain. So here, let us talk about the challenges in current system. So I'm taking an example of a supply chain, okay? Because all of us, we understand it's a common denominator. Supply chain is everywhere, whether it is healthcare, whichever industry you can think about. So at 12 o'clock, I have say for example, a manufacturing company, and at 3 o'clock, I have a logistic company, and a supplier at 6 o'clock, and at 9 o'clock, I have bank. So these are all four key constituents of a supply chain. I wouldn't call only these four are essential. There could be other players like insurance, and there are other middlemen or also, intermediaries are also there in a supply chain system. So now what happens is, in this supply chain, manufacturer first orders, he places a purchase order to the supplier for whatever it is. It could be 1 ton of steel, for example. And then once the supplier gets it, and then he gives it to the, where he started his manufacturing, he may be subcontracting something, remaining he is doing on his own, and then he's handing it over to the logistic player. And he makes an arrangement with the logistic player, either supplier or a manufacturer. The logistic player takes these goods and then he supplies to the manufacturer. Now, when the transaction is done, the bank honors, or they come into the picture to make sure that the money that the manufacturer owes to supplier is taken care. So this is a very small use case, I would say. Now, because all these four players are completely not connected in a digital world, they may have connections like email, faxes, whatever it is, even WhatsApp messages. They may be communicating to each other. But is the information relating to that one transaction, is it completely transparent to all of us? Is it completely, available for someone to act on it without using some external communication, things like email or something like that? So that is not existing today. Because of that, there are a lot of inconsistencies, errors, disputes, accuracy, all kinds of challenges in the system. That leads to some kind of a dispute or a reconciliation. So because, for example, take manufacturer is giving an order for 1 million, 1 metric ton worth of item. And if supplier is going to take that instead of 1 metric ton, assuming that he is going to take it as a 1.1 metric ton, it is possible because the data that he's getting through some channel, he can always, that could be an error, it could be a vested interest. So many things are possible. That leads to all these kind of challenges. Now, for example, let us see how it is happening in the blockchain world. So I call it as a magical invisible layer. So blockchain is a magical invisible layer. In fact, that's why we are talking about virtual as everything. What is this magical invisible layer does? It's an infrastructure layer. Okay. Now, if you see inside, I'm keeping that layer, and then in that layer, there is a ledger that is available. That's what we call it as a distributed ledger. Okay, the ledger is nothing but recording a transaction, recording an event, whatever is generated at a particular point in time, who is authorized to enter that particular transaction. This is the ledger. Everybody has a copy of the same ledger because it's called a peer-to-peer technology. Let's not get into too deep into the technology aspects of it. A peer-to-peer technology is nothing but it's a network. So there are multiple peer-to-peer. There are multiple peers. So peer-to-peer at random, the communication goes, and then all the peers inside that ecosystem, they have the same amount of information that it happens in a very, 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 very in a fraction of a second. So it's not even a second. It's not even a 0.01 second. I would say it is much, much, much faster. It is happening. That means almost real time. Everybody is having the same information. That's what the magical invisible layer is about. Now, this invisible layer, I don't have to worry about, about my own business. I can do my own business. I can have my own ERP. I can have my own systems, but still I can connect to this invisible layer through a concept called node. Node is nothing but a typical server. So if there is a node, I will connect to that node. I will supply certain information. I will record certain information in the node, which I want the data or information to be shared among all the participants. That's what I'm going to do. So when I do that, for example, let us see what are all the key features of a blockchain. So number one, it's highly authentic. Why? I think someone who was talking about the PKI technology earlier, cryptography, this is the best form of security that we can think of. There is a concept called private key and public key. So I have a key with which I can enter into the system and then do whatever I'm eligible to do. That key is being recognized by the underlying system that I am a right person to do that transaction. So with that key, when I come in, it is highly authentic because I have my key, because that key is being given to me with a lot of procedures and processes somebody has to go through before that key is given to me. So with that, there is an authenticity because I am the person who can do a transaction. I am eligible to do the transaction. There is nobody else having that key. That kind of authenticity available for the information coming into the system. Next, let us see. I am writing a, it could be anything. I can write a purchase order. I can write and I can put a music. You can think of any digital event or a transaction that I want to do. I do it. When I do it from my system through an API or directly into that system, I am say recording something called A. Okay, when I record that A, all other parties, this is what we call it as a consensus. All other parties agree that whatever you have written, you are eligible to write, and you have written, I have seen that, I accept it. So that's all. Consensus is nothing but it's not audit or checklist or something is going to go through that. It is technically done. That's all. Everybody knows that he is authorized to do this. Digital signature is verified. He has written it. That's all. All of them they accept. There is a concept called consensus. That through that consensus the data is coming in and it is accepted. The minute when it is accepted, it is highly transparent because everybody has got same A. There is no modification. There is no dot, no nothing. Not even a pixel is getting changed. Everything is everybody, every ledger has got the same copy, and it is happening like in a shifting path. So everybody has got, immediately. Now let us say this A, when I wrote it in a normal scenario, for example, if I am giving a purchase order, my system, my ERP procurement system, whatever I have, it's going to generate a document called purchase order. It could be a PDF, it could be a Word document, it could be any form, it could be. I can convert that into that format, use that to communicate with the other person. To, for example, supplier, I send this document to him. There is a communication channel. Now, this is the intermediary channel that is creating some efficiency issue. Because when I send, for example, I'm sitting in the US, I'm sending it in my 10 o'clock. Probably by then, India or wherever it is, the time difference is there. There could be delay. Anywhere, you wake up and then see, oh, that information reaching you has got some kind of a lag, right? The time lag. That is number one. And number two, after I get it, if I am a supplier, I send this information to others. So there is an intermediary process. So because of these delays, there is a kind of a, efficiency or a defect in the efficiency. Now, what happens in this system, everybody who's part of this ecosystem, everybody has got the same A at a time. So there is no need for anybody to communicate or take it forward, sending a mail or something. All these things are not required, and it is happening instantaneously. So it is highly efficient. Why efficient? The minute when I get the purchase order as a supplier, I start manufacturing. The copy of the purchase order immediately it is being shared with the logistic provider. He can schedule his logistic things. A bank, when it is going, he can prepare some documents, LZ, whatever it is, it all can happen. Now, the concept of APIs will allow them to take this information because it is coming from a trustworthy layer. They can process these things automatically, digitally, and then the transaction they can complete without any time delays. That's why I call it as a deficiency. Now, for example, the next important thing in blockchain is about, how am I preventing any any error or any issues in data. For example, for some reason, the logistic provider is making change to the data. Say it was A and he's changing to B. It could be anything. You can put a dot, you can put a comma, whatever. It cannot make any changes. That's what the beauty of blockchain is about. Assuming he wants to change, because end of the day it is digital, he has got access to it, he can go and try to change that. When he changes, others doesn't accept it because all of them, they know there is this A owner of the transaction that return, A return is manufacturer. So nobody else can touch that. Even the manufacturer himself, he cannot do anything to the A. Now B is not accepted. So when it is not accepted, it is reverting back to A because there is a sync happening. Because if he doesn't change, for example, if a logistic player doesn't change B to A, or rather he wants to keep B forever, if he's not syncing with the system, he cannot participate in this ecosystem. So he loses all the benefits. So automatically, when it syncs, the transaction details is coming to its original position. So that what it means is highly immutable. It is stored as it is when it was entered, does not alter, does not deleted, no changes are possible. That's highly immutable. This is the biggest trust factor that we can think about that is giving highest reliance on the blockchain technology. Then when it is immutable, you have got authentic, transparent, and efficiency, and highly immutable. Now there is a beauty of blockchain. The second generation blockchain. The first generation blockchain is a Bitcoin. The second generation blockchain is Ethereum and other protocols, where there is a concept of smart contracts got introduced. Because I have everything. I have a data which is authentic and it is immutable. I can rely on the data. Now I can put one more element into this, in the ledger or in the invisible layer called smart contract. Smart contract is not about a rental agreement we are signing or some kind of a contract that we are signing. Smart contract is a set of codes. It's a program. It's a set of codes that automatically execute something. You don't have to wait for someone to do anything. You can think about somebody who's here with some kind of a tech savvy or understanding of RDBMS or database technologies. It is like a stored procedure. If you set an event and if you set a trigger, automatically it generates some transactions, right? So that is what in blockchain world, it is a smart contract. It is just much more than stored procedure. Just I'm simplifying that. Now, this smart contract, it is before a ecosystem is built, before everybody comes into this, they all agree that this is the smart contract that we all agree, which is driving this use case. For example, if supplier supplies that 1 ton of steel, and if the logistic provider is taking this material and leaving in a godown or a warehouse of the manufacturer, the minute when it is done, if the agreement is that immediately X amount should be paid for the supplier, X amount should be paid for the logistic provider, automatically bank processes it and then distributes that money. This is a smart contract because we have agreed the purchase order conditions could be a smart contract. It could be anything, That smart contract is a kind of a execution happening in the system that all of them agree in advance. Anything happening in that fashion, we agree to that transaction. That's all. Now, for example, in this scenario, when the supply is done, automatically this transaction is entered, all the ledger, everybody is visible, in the system has got that information. So this smart contract gives a very big, the automation is a big plus point because you don't have to wait. Automatically things happen. These things drive some concept like, how do I transfer money from my bank? The bank is saying, okay, the smart contract says I have to make the payment. Now, how do I make the payment? The bank account? Yes, I can take money from the manufacturer account and I can put money into the logistic and the supplier account. This I can do because the banking world is well matured, so I can do that. But there could be scenarios where there is no bank, but still this transaction should happen. That means without bank, there should be a possibility of moving this money from one party to the other party. Because as a supplier, I don't have a bank account. As a manufacturer, you don't have a bank account, for example. I'm just giving an imaginary world because this manufacturer and supplier is, in our the current conventional world, they exist. But there could be some event maybe happening without connecting two people. They don't know each other. The transaction can happen. There, a concept of wallet is getting introduced because I need to have a wallet because it's nothing like, it's like a bank account. Bank account I have with the X bank. Similarly, I have a wallet, which is my own wallet. It is connected to some exchange or something like that, where money can come, a value can come, an economic value can come, and I can make sure that whatever transaction I'm doing, I'm getting paid for. That is a wallet concept, which is also part of a blockchain technology because that wallet in a digital, in a virtual digital asset, when we talk about it, I'll give you more understanding about that. So now, the next beauty of this blockchain technology, see, here what I'm referring to is we can connect very well with the transaction that is happening in our client environment as a chartered accountant. That's why I'm giving this example. Say there is something went wrong, some attack happened to manufacturer system. Now, all other ledgers having the same amount of data. So I don't have to rely on only one server because other servers or nodes are having the same amount of data. The transaction can happen without any dependency on single server. That is why I say it is a high availability. Even though there is an attack, since the ledger copy is available, where I have right to operate or right to enter something in that ledger, I can continue to do that. I don't have to worry about my system, whether it is available or not. So it is highly available. So wherever you go and then talk about, as a consultant, as an advisor, as an auditor, if you think about blockchain, probably these are all the strong pillars that is driving a blockchain technology, both for the commercial or enterprise world and also for the virtual world and also for the new generation business models, new generation ideas, fintech, innovative ideas, whatever you can think of. These are all the primary pillars that is driving those use cases for achieving some better financial world. Of course, when we talk about financial world, better financial world, there is other side always, the terrorism, fraud, all those stuff. There are a lot of steps are being taken how to regulate that. I think other members will talk about it. Yeah, just I'm confining myself to the technology side of the virtual digital asset and as well as on the blockchain side. So in summary, a blockchain is a growing list of records called blocks. Just I'll give you one small, maybe little bit technology will be there, but pardon me for that. See, what is blockchain? End of the day, there is a transaction. I say hello to you. Okay. Now, when you hear that hello, and then when you take it to next person, you may say hi. That could be a mistake, or intentionally you would have done that. Whatever. My hello is lost. Okay. Now, what it does is when I say hello, it takes that hello, put that into that invisible layer where everybody agreed that I said hello, and I am the person who did that because my key is recognized, and that record or in every block time, let us say, for example, block time in a Bitcoin world is about 10 minutes, okay? Because then within the 10 minutes, somebody is solving a problem to say that I am the leader of the network. Because whenever you are talking about a distributed system, there needs to be a leader who can agree for certain things. Because if you don't have a leader, then everybody is going to say what I say is right. So there needs to be a leader. That leader will agree that all these entries coming into the system in that particular block time is something I'm going to take it and I'm going to create a block out of it. Creating a block out of it is nothing but I'm going to get all these zeros and one, the bits and bytes, whatever is coming in. I'm going to put that, I'm going to do an activity called signing activity, and then I'm going to create a hash out of it. A hash is nothing but when you put all these zeros and one, when you put some method in a mathematical method, it will give you a string of zeros and ones. That is what that hash is about. That hash, you can unhash anything. You can again hash the same information to get this hash value. Now the hash value, anybody can prove that the underlying information is not changed because the final hash what I'm getting is same. So that's how the hash world is about. Now I got the hash. A hash is nothing but zeros and ones. And the next block, within the next 10 minutes, there's another block is getting generated. This hash value is the opening balance of that hash. And then there is transaction happening. I'm taking that opening balance and all these transactions, and then I, as a leader, I put a sign or I create a hash. Now, what happens when I keep doing it? Very frequent, highly frequent. I would say there are certain protocols where there is a blocks happening in few seconds as well. When you go up to a point, at any point in time in a real time, you cannot go back and change any of this information. That is highly impracticable. If you ask me technically, yes, technically somebody can say I can do it, but practically highly impracticable, I would say, because time it takes for you to go and then keep changing that is not possible. That's why we are talking about blockchain is highly secured with respect to the information that is getting into the system, and highly reliable because nobody can change this information. So this is what I call it as a growing list of records, because there is blocks are getting connected through that hash key from one block to other block. Now, how consensus is happening? There is a technology called, there is a consensus method called proof of work, proof of stake. There are multiple consensus methods available globally. So all these things are proven. There are new methods coming in as well. In fact, I have written a patent and recently got a patent. It's called FOMA. So we have got a different kind of a way of looking at how we can create a consensus in the new in the current scenario, because most of the consensus are like 100-year-old or 50-year-old. So we have come out with a new generation consensus method, which we believe will be ideal for the IoT world and virtual world. So there are a lot of technology innovation happening in that world. And the next point is about a timestamp, because when we talk about this transaction, it is not just I'm saying some 100 rupee debit and 100 rupees credit. It could be transaction is anything, any messaging, any whatever we can call. It is also have a timestamp. Now, globally, there is a global timestamp available. We are not talking about timestamp with respect to only India or US. There are global timestamps available. I put the timestamp. That is also getting into that block, and that is also getting hashed. Now, nobody changed the timestamp as well. And the timestamp and transaction data together with the hash pointer that gets that gets embedded in a block after block. That is what becoming a resistant to modification of the data. It is impossible. That's how the blockchain is designed. It is full of mathematical model. It is not like a logical model. It is a blockchain protocols are full of mathematical things. So how do you hash, and what is the block time? All those mathematical things are included in the blockchain. So next one is about, there are two kinds of blockchain. One is public and permission. When we talk about public, it is completely open. For example, Bitcoin is a public. You can go, if you are tech savvy, you can go and you don't need anybody else. You can write your own code, connect to blockchain, Bitcoin blockchain, and create your account and get your coins from somebody, or you can transfer your coins to someone. You don't need any wallet whatsoever. Directly you can go, you can write, but of course the wallets are getting generated from a blockchain technology, and you are kind of identified with an address, which is nothing but your wallet. So that is a public chain. So public blockchain is no limitation, no restriction whatsoever. There are open source. It's an open source technology. You can go, you can connect to that chain without any limitation. You can do whatever the purpose of the chain is about. If the Bitcoin purpose is storing a value, transferring the value. That's all. Bitcoin doesn't do anything. It just creates a wallet for you. When it creates a wallet, you have the ability to get some Bitcoins in your wallet and then give some Bitcoins from your wallet. That's all. It doesn't do anything. It just, for example, if I don't have any Bitcoin in my wallet, it is 0. If I have 1 Bitcoin, it is 1. That's all. It's just a simple ledger. And there are permission ledger. When we talk about permission ledger, the participants cannot get into that ecosystem without certain permission. The permission could be, defined by the governance layer of that blockchain protocol, where people will say, okay, if you are, for example, if you are a GST registered business, and if you are in Bangalore, and if you are dealing in steel, you can come and participate. Now you have to prove that you have a GST and your company is from Bangalore, and also you are dealing in steel. If you have some proof, you can come. The governance system will accept. You can do any transaction whatsoever you want to do. For example, we have deployed a tax chain. Tax chain is for a VAT in Europe. We have deployed a protocol that's a platform for companies like Siemens, Henkel, and large European companies that can come and share that information. So this is the beauty of blockchain. Now the permission blockchain, it will allow you to come in and then come in for a purpose. The purpose could be, you can define. For example, when we talk about this tax chain, there the purpose is, I want to exchange some information, share some information among all the participants for a specific purpose. Say, for example, maybe for members who are in practice for many years, they know there is a concept. There used to be a concept called Form C. So Form C gives you a credit. Sorry about that. So Form C gives you a credit for a tax credit for certain transactions that happen across the state. When you do that transaction inside the state, you can avail the tax credit. That is the Form C as a eligible document. Now, when this is being issued by the authorities, there are a lot of processes involved. Similarly, there is a concept called LTSD in European WAC. There we wanted to use a data exchange mechanism in a blockchain so that everybody is, for example, authority knows that there is a transaction happening, and I can rely on that document, and everybody knows that this transaction happened. So a lot of transparency and verifiability comes in. So this is one example of a permission blockchain. So it is not, it's like, for example, you can think about public hospitals and private hospitals. So private hospital got its own, access criteria and restrictions, and that's how it works. Similarly, public and permission blockchain. The advantage of this permission blockchain is you can have a use case defined. You can have only the members who you want, or the ecosystem, the governance layer wants to participate. Public, you don't have any control whatsoever. Anybody can come. The underlying use case is also already defined. You cannot do anything more than that. So that is the difference between the public and permission. Of course, DLT, it's efficient, highly verifiable, and the records are permanent. And this is why I call it as a blockchain and distributed ledger technology. Is blockchain is a concept, technology, and it is a concept. Distributed ledger technology is the derivative from the blockchain. So whatever you do, the distributed ledger technology is getting that information, and it is in the invisible layer. For example, there are concepts like Hedera Hashgraph, which is a third generation protocol. It is not a blockchain, but it is a distributed ledger technology. It gives all the benefits, and it is more efficient, and it is also cost effective, and it is also energy efficient. So we are talking about a different kind of technology which serves the same purpose, and at the same time it gives highly efficient way of doing, or the benefit of blockchain available in an efficient way. Why efficient? Imagine in a public chain, or even in a permission ledger, the first generation and second generation, the energy consumption is extremely high, because it becomes a big challenge for large enterprises to come and then use this technology, because it is not sustainable, because it is giving a lot of issues for the environment. So they don't want to do that. Now, given that background, the high efficiency is essential. That high efficiency with respect to energy consumption, with respect to cost, with respect to throughput, these are all advancements in the technology. Need not be a blockchain technology. There could be any other form of technology that can be accepted by giving the similar benefits or features that a blockchain technology can give. So that's what that's why we call it as a distributed ledger technology, which is a derivative of blockchain technology, and that could be any other technology can also come in. It can happen. So smart contract, I told you, just to give you a smart contract is not a contract that we enter between two parties in our General Contract Act or a Contract Act. Smart contract is a piece of code. It is a pre-agreed condition that we wanted to have within that use case or within that system. When the contract is written, it is automatically executes certain activities based on the information coming in, based on certain events happening. That's what smart contract is about. So let us not get confused with a smart contract to our normal agreements or contracts. So this is about blockchain technology. Now I'm just going to step into the virtual digital asset. Again, my earlier whatever I was referring to, the disclaimer reminds, I'm not here to promote the virtual digital asset. I'm not here to talk about any cryptocurrency specifically. I don't deal with any of those stuff. We are a technology providers. That's it. So, for example, what is virtual digital asset? I think Finance Bill 2022 clearly talks about what is finance, the digital, virtual digital asset, the VDAs. So now, if I can read it carefully, I have given some kind of a bold, the block fonts for something which is relating to technology. Remaining, it's all legal. It's all how you wanted to consider virtual digital, whether something is the virtual digital asset or not. So what it talks about is code or information or token. Period. Now, when you talk about code or information or token, everything in digital world is included. Because I write a code, I give you a PDF document. It's a digital asset. Whether it is a virtual digital asset or Finance Bill 2022, probably there are other points that we may have to consider to make it as a virtual digital asset. A cryptographic means or by any other means. So that means not just cryptographic means where I use some cryptography to generate that code or information or token, or by any other means. So that means at any technology that you use, cryptography or otherwise, then it is a the virtual digital asset. And what they are talking about is by providing a digital representation of value. Say, for example, I give you something which doesn't have any representation of value, digital representation of value. It is just I'm sharing a joke with you. It doesn't have any value. Then probably it is not a virtual digital asset. Then comes a digital representation value exchange with or without consideration. So I am exchanging a joke. There is no consideration. You're not paid anything. That's fine. But it is not. It is driven by technology because I'm using WhatsApp, whatever it is. And a code or information or token, probably it is an information I'm giving it to you. Whether it is a digital asset or not, probably I think as days to come, there will be more definition or more clarity with respect to what a virtual digital asset is. But here it says the other part, a store of value or unit of account. For example, if the whatever I'm getting, for example, if I say I have created a joke universe. Okay, I can give you a joke, and everybody in the system can accept that this is a good joke, and the joke I'm giving it a value is 10 rupees, and I can use that joke. You can transfer this joke to me as a owner. When I take that joke, I can use the joke maybe for my parking in our CA Institute building, whatever. Then we are talking about a store value. Then we are talking about I can use it for doing some financial transaction. Maybe I can use thousands of jokes if I store. Maybe I can buy 1 acre of land. I don't know. These are all virtually happening. You will be surprised to see how Metaverse world is growing. Metaverse world, there are virtual land is being bought and sold. So now, assuming that that is a scenario, then we are talking about the joke is a virtual digital asset. Now you look at that. It is joke is a virtual anyway, because joke is nothing, you can't see anywhere. It is just a piece of, letters or words. That's how a joke is, right? So that is nothing but a code when I put it in a digital format. I don't use cryptography, fine. It has got a digital representation value that is designed or defined by how that is being accepted. Can I have, if I have instead of my points in my wallet, for example, I have got, my airline has given me a point. So instead of keeping that point, this joke I'm keeping, that's all. So now imagine, this is what the basic of the virtual digital asset that we are trying to bring into some, tax regime. Okay. Now, all these things are very valid because the underlying, if you talk about the cryptocurrency, there is no underlying asset behind that cryptocurrency, excepting the fact I have given value to that when I bought. So when I've given value to that asset when I bought, you carry that asset with that value. And when there is this asset being a common asset, when the supply demand happens, the asset value goes up. Depending on, it is, momentarily there could be a, reduction in the value, but given the mathematical model of, say, for example, Bitcoin, which is capped at 21 million in 140 plus years. And it is also, there are so many mathematical models. For example, it says once in 10 minutes only you will be able to create a block because there is a problem that you have to solve. The problem is not that easy to solve. You need to use very high-end, the random number generator systems and cryptography systems to make sure that you are able to solve the problem. What do you get when you solve the problem? It was 25 Bitcoin for every time I solve a problem and become a leader and create a block, and it is coming down to 12.5, it is coming down to 6.25, it is going to be 3 and then 1, and then there is nothing. So over a period of time, only 21 million coins are available. Imagine the population. Somebody said that 10% of Indian population is having wallet or dealing in cryptocurrency. Globally, it is going to grow. When the supply demand goes this way, the value of that underlying currency is going to go up. It is not about what is that underlying value. For example, land. 100 years ago or 500 years ago, maybe 1,000 years ago, value, because you can go and then have your house there, construct, nobody is going to question you, but it changed. Similarly, there is we can assume that there is some value because I have created that value. When somebody sold a crypto coin to me, I have created that value by giving that money. I am just, instead of keeping it in my bank account, I'm just keeping it in this piece of code, in a wallet. That's how this digital, virtual digital assets are created and value is given. Now, that is what we are talking about in finance. Bill, anything that you are going to use for transferring, storing, trading electronically with some, which is just a code or an information or a token, if it is generated using technology and there is a digital representation of value and you can use it as a stored value because you, for example, you get X, you give 0.5X, you retain 0.5X, that is you are storing that value. This is what they are talking about, virtual digital assets. And there is another one they have included, non-fungible token, because as the technology evolved, there are new concepts coming in. For example, in a technical way, I can create a token. When I create a token, a fungible token is nothing but your kind of, similar. Every token is same. There is no difference between two tokens. For example, I give you 100 rupees, I can ask for 50 rupees. Everything is same. For example, end of the day, the value is same. If I give you 100, you can give you one more 100 rupees, same. That is kind of fungible token. These are all normal cryptocurrencies. But non-fungible token is exclusive. That token cannot be reproduced. That token is very, very, very exclusive. Think about, assuming that I got me as an individual, I got my certificate from CA Institute. Everybody is getting a certificate from CA Institute. And at the same time, with my number, which is given to me at that particular time stamp, say for example, lat long is your location stamp, latitude and longitude. With that, if I create my certificate, that cannot be reproduced because it's exclusively for me, then it is a non-fungible token. So when non-fungible token, it is programmed. See, end of the day, all these tokens, what we are talking about is a programmed derivative. I have programmed something. The derivative is carrying all the information that events and information that went into that program to create that token. For example, the non-fungible token, when I verify, it will go all the information, including my ownership to that non-fungible token. A CA Institute giving me a certificate, a non-fungible token, probably. But whether I can transfer it, whether I can keep it, maybe if I'm a member of say, Cosmopolitan Club, if they give me a non-fungible token, they may decide I can transfer it. So I can transfer to somebody else. But in CA Institute, it is not possible because I have to do certain activities to get that certificate. That's all. So it is technically, though it is possible, functionally not possible. But that is what we are talking about, the token, a non-fungible token, because it has got a value. A non-fungible token, everybody talks about a painting, okay? A new painting. I'm an artist. I came out with a paint. I put it in a digital world, and I say I create a non-fungible token because whoever owns this digital file, you have the right over that. You are the owner. Now, if this digital asset, if this non-fungible token or the art behind that, if it is appreciating, the non-fungible token value will appreciate. It all up to the buyer and seller to decide. And also the non-fungible token can be more than just, there need not be any underlying asset as well. So the non-fungible token can be purely virtual. So that is why they said a non-fungible token may be a little complicated model. It may not fit into any of the definitions that you are talking in the earlier scenario. Then they are talking about the non-fungible token or any other similar token is also considered as a virtual digital asset. Of course, in a normal scenario, the government would like to have certain modifications to these definitions at some point in time because first of its kind. So they have given any notification that may come in, may decide, or maybe they may include, exclude, whatever it is. This is what Finance Bill 2022 is about. So let us take a step back. Finance Bill 2022 is just a recent one with a lot of thought process. This has come in that we can clearly understand or see from all the English language that is being used in this, the definition layer. But the digital assets are not new. Virtual digital assets are not new. Maybe in India we have brought it in 2022, but globally, virtual digital assets it's called virtual assets, that is being controlled, because when it came to India, for example, some of you are who have used or buying bitcoins or any other cryptocurrency, they would have gone through that process. You have to go and then register yourself into an exchange or an intermediary, and then you will get your ID, which is, for example, if you want to hold a Bitcoin, then it is a Bitcoin ID you will get. That is your address. Then the exchange gives you an account which is holding all these assets into that wallet. Now, this is the process you go. But when you register, you just give your identity. You give your Aadhaar or or your license or a voter ID, whatever it is. You need an identity, and also there has to be a two-factor authentication. Now, how these concepts came in? Because we say there is, still the legal recognition is, we are thinking about how it is going to happen. We're not sure, but the financial bill talks about the tax part of it. But much before, I'm talking about 2018. That's the time when people started investing, buying, selling digital currencies in India. But these intermediaries came in and they were providing the service. Where is the regulation? Why did they ask for your digital identities? Why did they say that you need to have a two-factor authentication? These are all driven by an institution or a force called FATF, the Financial Action Task Force. It is kind of 200 plus countries. All of them came together. They have got this Financial Action Task Force to make sure the financial activities across the globe. If you talk about AML, you can talk about multiple things, to restrict the terrorism-related activities or any fraudulent-related activities in the financial world. The Financial Action Task Force was created long ago. They came out in 2017. They realized from 2008 they have been talking about these virtual assets, and they came up with a lot of standards and regulation. All the countries are following, and also the exchanges, they are also following the same recommendations. That is why we are talking about your KYC concept, your authentication concept, like your two-factor authentication, all those stuff. This is being considered as a standard for anybody. The virtual asset service provider like the VASP, they all follow this. It has nothing to do with the country, because it is something to do with the making sure that they are not considered as part of the terrorism or the fraudulent related matters. That's why all these exchanges, they follow this concept. Now, according to them, what is a virtual asset? It refers to any digital representation of value that can be digitally traded, transfer or used for payment. It does not include digital representation of fiat currencies. Very simple. They said anything outside of this, we don't consider as a virtual asset. It is about digital representation of value that I can trade or transfer or use for payment, whatever way, for an economic value. And it doesn't include a fiat currency of any. When they say fiat currencies, it could be rupees or it could be dollars, it could be anything. It's any currency, any country's currency. That's what fiat currency is about. So they have defined virtual digital assets in this format. Now, we are all talking about, the criminals misuse virtual assets and virtual currencies and cryptocurrencies. This is an example, for example. What is the underlying impact of the criminal activity? That is what the FATF is worried about. It's not about the activity by itself. Activity by itself, it exists. If I just come and then pick your wallet, you have 1,000 rupees, you lost 1,000 rupees, I gain 1,000 rupees. Assuming the 1,000 rupees you are holding it for, for a medical emergency for your relative, then it is not 1,000 rupees. It's much more than that. That's what they are talking about. Virtual criminal activities will lead to substantially, high loss for the society. It's not about the amount that is involved. If somebody was saying that there is people without knowledge, they are getting in, they are losing their money, that's fine. But the impact of the loss is not that money. The impact of loss is much, much more than that. That's what they are talking about. Here, that a few years ago, we all even now the ransoms are happening, using a Bitcoin as a method of payment. So here, what happens? They see the virus, they see an agent, they use a backdoor entry to make sure they get into your system. They freeze your system. When your systems are frozen, it's encrypted and a lock is created. Now you need to unlock that. You need a key. They say, I have a key because I have locked it. You just pay me X, I'll give you the key. That's what the hacker is talking. The ransom payments he is demanding. I'm going from left to right. Okay, the hacker is receiving a wallet, and then in that wallet he is asking for the payment. So everybody is giving. Okay, I'll give you $500, 500 coins, whatever it is. Then he's layering it, because the beauty of all these cryptocurrencies are, if you have an ability, technically, if you can go, you can track back which address it came from, you can go to the history, and then you can build a model to see where this got started. For example, first miner would have got the Bitcoin. If I'm a miner, I would have sold to someone. It keeps happening. They can go up to that miner. Now in this layer, if without this FATF kind of a standard or regulation, it stops. Nobody understands, because only my address is there, which is zeros and ones. We don't know anything more than that. But with this kind of a KYC activity, you can associate a real person behind that key, and then possibly you will be able to figure out where this transaction happened. But there is a technology, they call it as a layering. You give me, assuming that you have some Bitcoin, you give me your Bitcoin, I will whitewash it. What whitewashing is, I will give you a fresh Bitcoin from a mining company. I will take this and then I will liquidate in the market. So there are so many things happening in the technology world. Now, with this hacker, whether he can send this money to others or take it to the bank account, I think that is where FATF is saying that we will be able to limit this kind of activities if all the countries, if all the regulators, they follow the standards and regulation that is provided by FATF. Now, in this process, what happens? The underlying impact, if you see on the left-hand side, there is a highlight. It's an $8 billion worth of impact happened because want of healthcare, want of supply chain, want of travel, anything. A flight is getting delayed because there is a hack. All these things put together, they have assessed it's about 8 billion. What did these hackers got? They got about 100 million. So the loss is 100 million, but eventually the consequential loss, which is impacting the society, is about 8 billion. So this is what is bothering. It's not about 100 million. People lose this money for many reasons. In stock market, they lose money, but that is not impacting the social, loss. That is what people are talking about in virtual asset. We have to be extremely careful. It is like yesterday was Earth Day, right? We talk about Earth Day, greens, all those stuff, then we forget it. But the impact that our social messaging in our group, WhatsApp group, that is creating, probably it is over a period of time. Maybe one person would have survived throughout his life with the oxygen that our WhatsApp group message would have consumed. We don't know, because the underlying possibilities exist. That is what we are talking about here. Now, quickly, I will move into what are all the types of VDAs. It's very, very subjective, because it is not like a school book or a science which is saying that this is the definition. It's vast, it is growing, and you can think about the definition that is given in finance bill is very valid. You can think about anything that you can consider as a VDA. But the common VDAs that we are currently dealing with, cryptocurrencies. So Bitcoin, Ethereum, Litecoin, and XRPs and HDOCs, thousands and thousands of them. Is all getting created by somebody for a purpose. They came out with a concept called initial coin offering. They see the coins, they retain some coins, they will leave it to the market. Market, depending on the first person buying, he creates a value for that, and then the next person buying creates a definition of the cryptocurrency and the value, and the supply demand in a bulk way. When it goes the supply demand, that defines the value, and the coin exists and it keeps going. There is no coin that doesn't exist. Maybe it doesn't, they don't trade those coins, that's all. But all the crypto coins that got promoted and that got into the universe, they exist. That's all. Nobody can undo it because technically it is not possible. So these crypto currencies are one type of VDAs. The next one is crypto commodities. What is crypto commodity? In the technology, in the crypto world, for example, if I build like a fund of fund, okay, I build technology that can generate virtual digital assets. That technology itself is a commodity. For example, Ethereum. Ethereum is a technology, it's a protocol. They created Ethereum. On top of Ethereum, there are a lot of cryptocurrencies, crypto assets are being developed. So that is considered as a crypto commodity. Even crypto commodity is backed by an asset called Ether. So they call it as a cryptocurrency, but the underlying technology, underlying purpose is kind of crypto commodity. The next one is utility tokens. For example, I was talking about a cosmopolitan club, right? Assuming that there is a virtual club that I'm creating, say Facebook or anything. And I'm saying that you can come and do participate in this use case or an ecosystem, and for everything that you do, you need to pay one token. So that means there is a value for the token, because it's a consideration I'm paying. It's like the barter kind of a transaction where I'm paying this consideration, this token. So this token has got a value. I have to buy this token to do this transaction or activity. So when I want to buy this token, the token value is determined by the supply and demand of the token economy of that particular use case. Now I have to make use of that token for doing certain utilities that I wanted to avail. That's a kind of a utility token. Security token. Think about our stock market. Think about our company stocks. Think about a gold-backed token. You can have an underlying asset. On top of that, you are creating a token. So that is called security token, because the security tokens are used for primarily to avoid any, to make it more efficient. For example, if there is a company, the company stocks are say 1 million equity shares they have issued, there is a face value, everything is fine. If they denominate it, and then instead of giving it as a paper document or a PDF document, if I'm going to give it as a token, you are the owner of this company as long as you have it in your wallet. Then when I transfer to somebody else, maybe I don't need any intermediary in the system, because purpose of blockchain, if you go back to my definition of blockchain, disintermediation is one of the important aspects. So I can disintermediate the whole thing. I can have the ownership of the company. End of the day, company for other than your certain SEBI and other regulatory aspects, company for the performance of the business, they need this capital to run their business, to buy assets, to run their working capital, whatever it is, they need that. That is taken care. I don't care who is giving me that money, but the regulator said you should know who is giving you the money, and you should know how much percentage who is holding. Then it's a regulatory aspect, right? That's what the SEBI and a whole lot of these know your investor and all those stuff. But I can tokenize it. I can allow people to buy the way, because after I give, there are exchanges that is taking care of all these transactions and other stuff, right? Probably the security token, again, imagine it can facilitate some advancement in that world, the stock market world, or it could be a security token could be for securitization. For example, if anybody in a banking side here, I used to run the back office for ICICI. The securitization is about primary lending happening at a bank level. Assuming I'm doing a lot of micro lending, I'm doing a lot of agri lending, I'm doing a lot of retail lending, but banks are compelled to the lending certain percentage they have to do, because that is what RBI wants to promote ultimately. They don't want to have the concentration in one particular asset. They want to have a well distributed asset in the banking balance sheet so that your NPAs and other issues can be under control. Now, I'm not able to do my retail lending, for example, because I'm a small bank. I don't have the wherewithal to go to market, create that market, which is expensive for me. So at the same time, if somebody else is doing that retail lending, I can promote, I can participate in that. They can create all these securities, they can create one basket, put all the assets. For example, X bank has done some 500 crore worth of auto lending, which is a retail lending. I can say that 500 crore is available. A bank, whoever wants to participate in that, you participate. I will give you a discount, or mine is at 16% IRR or 8% IRR. I will give it to you for 6% IRR. I will retain that 1% or some basis point. This is a securitization transaction, right? Now, instead of doing, because there's a whole lot of 15 participants in that, and there are so many challenging aspects are happening in that world. Can I create a token? For example, every auto loan I gave is a token. Instead of doing that 500 million, I've got some probably 5 million tokens with me. Anybody wants to participate, you take 1 token, 5 token, 100 token, we can do a transaction. That is the benefit of security token. Now, what happens in US, there is a concept called only high net worth individual, they can participate. They call it as an accredited investor. Accredited investor, by definition, they can buy these tokens, sell all those stuff. Until 99 accredited in that ecosystem, it is possible. They can participate in a kind of a bank kind of a transaction without any regulatory issues. So this is the advantage of security token concept. Even probably in India over a period of time, if it happens, probably it will be a good financial leverage concept, I would say, because end of the day, I don't have to invest in a intermediary mutual fund or whoever it is, allowing them to take their decision and invest in some other asset. If I have access to that asset directly, I would rather put my money there. So I am better under controlled risk, whatever term you can think of. So that's the concept of security token. That's where it is heading to. Hybrid tokens, same security token. For example, it is a membership in Cosmopolitan Club. I'm having that token. At the same time, it gives access to the Cosmopolitan Club because I have a token. So that is kind of hybrid. Every time I go, there is a reduction in my value. All those things are considered as a hybrid token. Non-fungible token, I just briefed you what non-fungible token is about. And that non-fungible token in the recent couple of years' time, it's growing. It's growing because the underlying concepts, the technology concepts that blockchain is driving, it is also growing. Say, for example, the metaverse. The metaverse is a concept where we are, the technology world is thinking about the blockchain world, or people who are so fond of blockchain, they are all thinking about creating a virtual world that you and I, instead of meeting in person or discussing in a media like this or talking in a phone, we can literally see each other, because I am an avatar, you are an avatar in that world. Both of us can meet in a particular spot, and then we can do a transaction, because everything is connected in the digital world. For example, when I meet you there, I can give all my identities, because I have got a self-sovereign identity, Web3 based identity. You know who I am, I know who you are. And if I am asking for, say, for example, I want you to do my audit of my carbon assets that our social purpose project is, reducing some GHG factor, then I have a carbon asset. I'm going to say, hey, this is my carbon asset. I want you to certify. Probably in a digital, in that meta world, you will be able to see, okay, this is the standard operating procedure. This is the checklist, and this is the video, and this is what you have done. I'm seeing everything. Okay, I'm approving. The minute when you approve, I get that credit. When I get that credit in a token, I can give it to somebody who is creating more emission. For example, an electric vehicle owner or a company, they can get this credit and they can give it to somebody who's probably a car manufacturer who's manufacturing the conventional petrol or diesel cars because they are creating emission. No, we are talking about society getting benefited because somewhere we wanted to reduce a degree of heat in our atmosphere. So look at that. So these are all possible things that can happen in metaverse world. They're talking about it. It is very weird, but all of us, we should understand 15 years ago, Facebook was weird. 10 years ago, WhatsApp was weird. But today, we are using that as our core thing. Without that, probably we will not be living, right? So that is what is the communities, the younger generation is talking about, the advancement of technology is talking about, these things will come in. So the VDA, it is just the first set of VDAs we are talking about. There could be many such VDA types that may come into existence. For example, the metaverse land I'm talking about. It is not a real land, it's a virtual land. Because if you are talking about this kind of a metaverse universe, even there needs a land, right? Because you are going into a building and you are standing there as CA, I am coming here as a client. There could be a different setup or environment or a configuration, but they are defining, they are mimicking the real world. So that means there is a land. You may need a land. So now when you get a land, there is a value for it. So that land is also a virtual digital asset. So there is a, whether it is considered as a utility token, security token, if it is falling in any of these categories, that's fine. If it is not, then we are talking about another dot coming here as a seventh dot as a metaverse property possible. So we can think about any inclusions as it goes. So typically, if you buy a VDA, in this scenario, cryptocurrency is very common. I'm not getting into any other virtual DeFi and other stuff. DeFi is nothing but, for example, in a banking world, there are so many financial instruments. If you can convert those financial instruments in this concept, what VDA definition is about, for example, if the securitization document, what I'm talking about, it is a DeFi. So a gold based, if I create a futures document, then probably it is a DeFi. So there is any financial instrument that you can think of that can get into this kind of a supply-demand boundaries, or with a real asset behind. At the same time, there is a possibility of ownership that can transfer the cryptography way or a technology way. At the same time, I can own those concepts. If you apply, that's a DeFi. It is maybe there are new kinds of instruments coming in our way. For example, the metaverse land, what I'm referring to, though I can call it as a land, it's a new type of instrument, right? Because you are not going to a local registrar office, sub-registrar office to do a registration. It is something happening in the virtual world. So those things can be, coming in. But generally, if you talk about a Bitcoin or any other cryptocurrency, we need to consider these 5 factors minimum, because you can go to any exchange, you can go to anybody to buy or sell, that's fine. But you need to understand which location you belong to, what is your location-specific regulations, because every country has got its own regulation, whether it is allowing or not allowing, irrespective of that. If it is not allowing, then you have to be more careful. If it is allowing, then you have to consider what is that regulation is about. If they say that I'm not allowing, I'm not talking about it, maybe your other system, financial system, banking system, has got something to talk about it. We should be careful about it. In India, in my understanding, they are not talking about the cryptocurrency, but definitely the Banking Regulation Act and the RBI regulation and other areas, they are talking about after barter system. What is the currency that the government has given, how it should be used? There is a definition. Probably a legal expert can say, whether a cryptocurrency in India is really legal or not. They have to go through that process. So the location-specific guidelines or legal aspect should be considered. And the payment method. How are you going to buy it? Are you going to buy it using your cash or using your bank account? How are you going to buy? Because how are you going to buy is also something to do with your KYC, your identity. Because if you are leaving an identity and you are buying an asset, then you are exposed to certain legal risk. What I was referring to, if there is a person, the minor, He is assuming that he has sold it to somebody in the system who is not really known for good reasons, and you go to the market and you bought, assuming that the Bitcoin or any other currency you bought is coming from him, then you're part of the transaction. That is how the regulation, not I'm talking about the India regulation, general regulation, universally it is being treated. So it is better that you identify yourself so that you are known, that you don't have to prove later. That the payment method is also something important. And type of VDA, what do you want to buy? Are you buying a cryptocurrency? Or are you buying any other security token or NFT? These are all important things for you to decide how you want to buy that particular asset. And cost of fees, it is some invisible. Sometimes like your foreign exchange, you just transfer money, you don't even know what is the exchange rate. It's all invisible, right? So here it is invisible, because you are giving that and the exchange is saying that this is my fee, but the real transaction we don't know, because there is not much of transparency available. But still you need to understand what are all the components of the cost of fees for you to do a transaction and how much you can afford. Because end of the day, whether it is insurance or a bank deposit or a share market or any asset, financial asset, because your financial health is very, very important, especially when it is a consumer level. They should know for example, if I'm earning X, probably 0.1X I can afford, or 0.01 I can afford. I need to have my risk profile, because it should not impact my financial health as well. These 5 important things one should consider. They should, for example, when I say type of VDA, you should completely understand what this VDA is about. If you don't understand what this VDA is about, you are exposing yourself to multiple risks, not only financial risk. It could be a legal risk, it could be a reputation risk, it could be, your future, anything can impact you. So you need to understand that VDA inside out. Without that, attempting is not that advisable. And wallet, I was talking about important aspect is, you need to have a wallet. Without wallet, no transaction can happen. See, wallet is nothing but it is your identity in the crypto world. Because when you say I have a wallet, that means you are associating with a particular VDA. That VDA source has given you an identity. That identity is in the form of wallet. That's how it is. It is a store. It is, for example, it's not about a cryptocurrency. Any wallet for this. If you are talking about NFT, you need to have a wallet to hold that NFT. Because the NFT, where will you hold? You cannot. I can store in my laptop or in my mobile directly, but it is very risky. So if I'm having a wallet which is provided by the source, it is much easier. People can recognize when they do a transaction with me. I don't have to do anything. They recognize that I am the owner and I'm authorized to do. I can easily transfer. That is what the concept of wallet is about. There are 3 types of wallets. One is the online wallet. It is a web. You go register in that site. Whoever is providing that asset, you register. They will give you a wallet. You download your wallet. They have given you a private key. You keep that private key. Activating that private key, you may have a password. Use that. They may ask you multiple questions. There is 2-factor authentication. Your wallet is done. Once your wallet is done, you can keep buying. You can associate your bank account or whichever mode you want to pay. You can associate. You can buy or you can sell. The underlying fiat currency transactions will happen in the associated bank account. That is how this is online wallet. It could be a software wallet. It is nothing to do with your online. I have a mobile app. They have given you a mobile app. You just download and you can keep that. It is much safer than online wallet, because mobile is in your control. There is a 2-factor authentication. There is a OTP kind of a thing possible. Multiple security things are possible in your mobile wallet. So that is much safer than online wallet. The third one is hardware wallet, which is like your biometric. I can put my finger, thumb to activate my wallet. It's a device, okay, typical. Or I can insert that like your digital signature certificate, crypto key. I can insert and then I can do a transaction. It is highly safe because it has got all security elements covered in that. So the wallet, what you want to have, depending on what VDA you want to transact. Every VDA will have its own method of giving you a wallet and converting that asset or a token that you can keep. So every VDA you want to buy will have its own wallet. But do you want to have 1,000 wallets for doing transactions with the 1,000 cryptocurrency? Not necessarily. There is a concept called exchange. They can give you a flexibility of keeping all these assets in one wallet, and then behind there are multiple wallets. That is when you deal with that particular assets protocol. So these exchanges help you in keeping all these assets in one place. So otherwise, if you are dealing with Bitcoin, you need to have a Bitcoin wallet. If you are dealing with Litecoin, you need to have a Litecoin wallet. If you are dealing with a wearable NFT given by some Nike, you need to have an NFT to hold that. There are NFT marketplace. You can go there, you can hold all the NFTs. So this is how the exchange and marketplace are giving you a comfort of keeping all of them in one place. Maybe there are security and other aspects one need to be aware of, because if I lose my address, that's a private key, right? If I don't remember how to activate my private key or where my private key is, your underlying asset is gone. So there are a lot of additional value-added services the technology guys are providing to make sure that your address and your identity is securely held in the cloud somewhere, and at the same time they have given you some way to retrieve that if you forgot your password or something like that. They've got certain concept. So these are all the technology advancements happening, which is nothing new. In our normal world also we can retrieve our passwords and all those stuff. But here it has to be more careful, because there is an underlying asset which is the economic value could be much higher. For example, a guy who bought one Bitcoin 15 years ago, maybe he is sitting in a pile of gold, right? So we have to be a little careful on those aspects as well. So this is generally about the virtual digital asset and blockchain behind that. So I hope I was able to cover within the time. Any question? Okay. Petal Agarwal has got a question. Kindly explain taxation on VDA. From my understanding of crypto, there is a bit what trading in crypto, thousands of buys and sells that happen continuously. So what is the point of taxation? When will the owner of crypto be taxed? It's out of syllabus for me. Probably Sachin or somebody else can take up, because they are well versed about the Indian taxation system and some new things that is coming in that world. So I'm sorry, I cannot answer that question. What are the prerequisites to install blockchain, and should it be installed by all concerned? Yes, it is a prerequisite for installing a blockchain is, for example, there are open source. You can go and if you know the technology side of it, how to activate a blockchain, how to participate in that node, you may have to go through certain steps. Every blockchain protocol has got a white paper, which has got a technology part. In the technology part, clearly it is identified how you have to download, how you have to activate, how you have to, there are so many things. So you have to do a little bit of technology thing. Once you do it, then you are part of the ecosystem. So you have your node, and of course, node is nothing but it can be your computer, it can be your server in your office on-prem, it can be a server in the cloud. You can have that node anywhere you want. So once you are activated, you are connected. When you are connected, then you are part of the ecosystem. They should accept it. That is the next one. If it is a permission layer, they should accept it. For that, you may have to take some steps. If it is a public layer, you don't need any permission. You are part of the system anyway.
Couple of questions here. Are you able to hear? Are you able to hear?
Yeah,
Sir,
I'm
able to hear us?
able to hear. Yeah.
Thank you. One minute. Today, we're all talking about this digital asset, NFT, all that. And the technology is great. Thanks to you that you made us aware of the concept, the technology, so we're able to please understand what is that, what's happening. Want to understand because any time when a new technology comes, it's pretty expensive for the common use. So what is the status today? But suppose if an artist wants to post this music on converting that into NFT and then use that for selling it, is it economically viable today? And what kind of costings that are there in general, what it is? So I also understand when the transaction has to be done, there's something called a gas fee which has to be paid and it's pretty expensive as such. So compared to the regular world where I go from an app store and pay 18 rupees for a song, but if I have to go to this NFT and then on this song use that, how does it work? I mean, how much will people do?
Yeah, I think the good question because affordability is always a point. You know, what is the return on investment and is it affordable? It is a subjective, right? Because for example, you know, if we are talking about the electronic bill of lading, right? We have created an NFT for every electronic bill of lading because electronic bill of lading is completely a paper-based process so far. Now, the International Chamber of Commerce, they have allowed electronic bill of lading to be considered in the technology way, but you cannot do a simple PDF because there is a huge risk, right? So we are talking about NFT. Now, transfer of those kind of, imagine those kind of a scenario. There is the cost to run that ecosystem, cost to, you know, own that NFT or transfer that NFT is absolutely very low compared to the benefit that you are going to get. Even if you are talking about, you know, moving that NFT, the bill of lading from one location to other location through courier, you are talking about thousands of rupees or hundreds of dollars. If you are talking about multiple such transactions happening in the life cycle of that electronic bill of lading, it is big. It can be thousands of dollars. But having a technology with the scale that we are talking about, then it is very ephemeral. It's not a big amount at all. It is immaterial. So that use case, people, they would love to have this concept because there are other commercial benefits that they can think, which completely, you know, is multiple times than the cost that they may be incurring. That's number one, scale, and number two, the benefit, right? So if you see these two concepts, wherever you are talking about a virtual digital asset, if the scale is high, if the ultimate benefit or the value of the virtual digital asset is high, then the underlying cost is affordable. Now, for example, if you want to do a transaction for 10 rupees and then if you want to do a blockchain-based transaction with a low scale, it's highly expensive. You cannot even think about it. So your question is valid. We need to have a right use case. Without that, the affordability is a big challenge. And at this point in time, the biggest challenge is the protocols are still maturing. I wouldn't call it as a current protocol as end of blockchain. There needs to be further protocols coming in our way where the fairness and cost effectiveness and throughputs, everything is much better. When that kind of a journey, we are in a blockchain technology journey, right? We are not at the end of blockchain. It may go for another 100 years. It may take another 10 to 15 years for us to see the full maturity. In that technology advancement, we are at a point where a lot of new things are coming in like VDAs and other concepts. But as the usage goes up, as there is a push, the technology advancement will happen. In my understanding, by 2025, 26, we will see extremely cost-effective ecosystem coming in our way. And anything specific to some questions that you asked, sorry, I'm not able to hear clearly, but this is in a nutshell for everybody's understanding. This is the cost aspect of it. And the cost is simple. You know, you're not talking about anything, you know, new. It is your server cost, your computing power cost, and your storage cost, your communication cost. Nothing else. This is what is inside the blockchain technology. There is nothing new which none of us know is inside. It's nothing like, you know, you have something in move. Everything is the similar, the technology for a ERP to host or your any other technologies to host, that is the underlying technology. But the compute power is very high because it has got certain concepts like cryptography concept, random number concept, and all those stuff. That takes a lot of computing power. And the storage is a little high because it is all the transaction right from the genesis or inside your block. So that means the block is growing, right? To that extent, the storage cost is also high. These are all two important aspects relating or driving the cost factor, but all the benefits, if we can think, this may not be all that expensive proposition.
Thank you, sir. Talking about this NFT and in the real world, what I understand is that there's a painting, there's the original, which is the highly valuable, and there are the copies of that. But I understand in digital art, if you take it, is there also a original and then the copy, or some people say no, there are 100 things are there, all are equally valuable. Getting confused there, what it is, because the 100 NFTs are the limited tokens, is what they call the 100 or 500, they keep discussing, and each has got a value. But in the real world, what we have seen is there's a original and there's a duplicate or a copy. Just some light on that.
Yeah, I think we are limiting our thinking of NFT to a painting, which is subjective. What you are saying is absolutely right. Even the original painting that I have, I would have created an NFT for that. As long as this original is with me, I can transfer this NFT to somebody. I can transfer this original to somebody. So there are a lot of double spending can happen in that world. Double spending is avoided in the technology layer. Double spending can still happen in the physical layer. What we are talking about is if there are 100 NFTs getting created for the same painting, okay, that 100 NFTs, there is no double spending with respect to that one NFT. That is the technology part of it. But if somebody is creating an NFT for the same painting, one more guy is created and he has put it in some other NFT, those kind of regulations are not yet in place. Today, if you see, I'm coming out with my avatar, I'm creating an NFT, I say that this is my NFT, I put it in an exchange, people who want to buy, they are buying it. That's how it is working. More maturity should come with respect to NFT regulation itself. There are technologies coming in. For example, behind the scenes, there are a lot of technologies coming in to kind of deduplicate the NFTs. For example, if you create an NFT, if I create the same NFT with the same picture, there's a deduplication process. It will tell me that there is a copy, there is a fraud. So I will be limiting myself to decide which is the original NFT. It's a timestamp. It is my identity. It is the reputation score. For example, reputation score is nothing but like you in your Uber. When you go, you as a rider, you have got 4.8, 4.9, and the driver has got 4.8. So that kind of a reputation score is possible. Now with all these elements, a recognition of NFT and its value will happen in a mature way. So right now, what you are saying is absolutely right. It's a very early stage. People are just rushing, and they are doing all kinds of investment. And maybe what is stopping me from selling an NFT for $1 million today, and then I am buying. That's possible, right? I'm creating a value for my own NFT. All these things are happening because there's a concept called Web3, and there is a concept called my own identity in Web3 world. If that happens, this is not possible because my identity is a single identity. Everybody will know with my identity, me in the virtual world. If that happens, I will not be able to do because people will know that I am the guy who have created that value. So all this, it's a very challenging world. A lot of maturity is happening. Your question is very valid. If even I have the same question, but this is the answer to your question.
Thank you, members. Thank you, Ravi. It was really interesting as well as more informative. So, remember, we are just taking a break for next 10 minutes, and we have about